Good evening, everyone. Welcome to tonight's webinar. My name is Abigail, and I'm a marketing executive and also a dealer at Phillip Futures coaching branch. So I'll be your speaker tonight. And before we start, I would like to do a sound check. Can you guys hear me? If you can hear me, can you just click a yes? Okay, I see that you all can hear. That's good. All right. Okay, so first of all, I would like to emphasize on this disclaimer that whatever we share tonight is just for general information, and it does not constitute any recommendation to buy or sell any investments products. Yeah. And for those who are new tonight, just a little bit of introduction about our company. Phillip Futures is a wholly owned subsidiary of Phillip Capital, and we are incorporated in the year 1995. So Phillip Futures headquarter is based in KL, and we have branches across Malaysia, such as Kota Damansara, Johor, Penang, Melaka, Kuching, Cebu, and also KK. Phillip Futures is also a trading participant and clearing participant of the Bursa Malaysia derivatives, and we are also a holder of a Capital Market Services License, or CMSL, which means that we are a legal and regulated broker house in Malaysia. So we are actually proud to be awarded by Bursa Malaysia as the first runner-up for the best overall, best retail, and also best institutional derivatives trading participant in 2020. So I'd like to just take this opportunity to thank and appreciate our clients for their trust and support in us. Because of that, we are able to win these recognitions. So our mother company is Phillip Capital. It has a wide network around the globe. We have offices in over 14 different countries, as pointed out here. And for futures, we also provide products listed in other exchanges like US, Europe, Japan, Hong Kong, and Singapore. So with our global coverage, clients can trade both local and foreign products within the same platform. So Phillip Futures offer two main line of products, CFD and also contracts for difference, which is futures and also CFDs. Yeah. So for futures, we allow our clients to trade different categories of products, such as index futures, metal futures, agricultural, energy, and also interest rate futures. And for those who trade the stock markets, we also have share CFDs in the Bursa and also US markets. Okay, so why choose Phillip, right? First, we offer 24 hours broking and execution support for our clients. You can call in our dealing desk if you need any help. It's especially helpful for those who are trading the foreign products at night. And next, we also send out latest market news and commentaries to our clients every day via email. And then we also provide a wide array of products that allow our clients to trade both local and also foreign products. And lastly, we also provide advisory service on what kind of products you want to trade or how you can get started on trading. Yeah, and other than that, we also provide a free one-to-one coaching sessions, free webinars and seminars, and also free account opening. And in our coaching sessions, they are more targeted to beginners. So we cover topics like introduction to futures trading, product knowledge, platform coaching, and also charting system. Okay, this is our upcoming webinar session on the 18th of March, which is next Friday. So feel free to join us. We have invited speaker to talk about the market outlook and also trading strategies on the FKLI market. So the session is free. You can scan the QR code below to register, or you can also look us up on our Facebook at Phillip Futures Sdn Bhd, because we do always update all our programs there. Okay, so let's dive into our topic tonight. We'll be covering some of the basics on the futures trading, especially on FKLI and also FCPO. So the outline will be what is futures, or why trade futures. We'll introduce on Kuala Lumpur Composite Index Futures, which is FKLI, and also Crude Palm Oil Futures, which is FCPO. And then we'll talk about what are the factors that drive these prices and how you can use futures for hedging and also for speculation. Okay, so what is futures, right? The definition of a futures contract is basically a legal agreement to buy or sell a product. Usually, it is a commodity or financial instrument. So you can, you can buy or sell this product for a specific price on a known date in the future. So futures contracts, they are typically traded on the exchange like BMD, SGX, or CME. Okay, so how does it work, right? So a futures contract will lay out the details of the agreement between the buyer and the seller. So let's imagine, right, there is a farmer or a seller who wants to sell his corn, for example. And then there is also a popcorn vendor who needs to buy corn to make popcorn, right? So they can both come into agreement to buy and sell corn using a futures contract through a broker. And the contract will specify the product they are trading. Okay, like for this case, it's corn. Okay, they will also list what is the quantity, let's say 25 bushels, and the price they want to buy or sell. Let's say here is $5. And also lastly, the delivery date or the expiration date. So if both parties hold the contract to the expiration date or the delivery date on June 14, okay, the seller will need to deliver the corn to the buyer, and the buyer must make the payment to the seller. So this is how the transaction takes place in the physical market if you're using futures. So usually for physical delivery, like these are more common in the commodities market lah. Okay, for futures products, there are four main categories. Agricultural futures such as wheat, corn, soybean, or crude palm oil. And for index futures such as Dow Jones, S&P 500, the Hang Seng Index, and also KLCI. Then we also have energy futures such as crude oil, natural gas, and gasoline. And then lastly here is metal futures such as gold, silver, and copper. Okay, now we come to this part which is important to know. Futures contracts that have terms that are standardized. So I will go through some of the important elements to take note lah. Okay, the first one is underlying instrument. Basically, it is the underlying asset lah, or the product. The product of the contract. So for example, if it is a soybean futures contract, then the underlying asset will be soybean. Okay, next is contract size. This is the quantity of the underlying instrument. So the contract size will outline like exactly how the amount of the commodity or the asset that can be bought or sold. For example, one contract of FCPO is equivalent to 25 metric tons of CPO. And then we have this minimum price fluctuation. This is basically the smallest price movement possible in trading a contract, or it can also be referred to as a tick. And then value per tick, what it means is that for every minimum price movement, how much is the value in that change of the price movement? And then there are two types of settlement for a futures contract. It's either cash or physical delivery. We'll talk more about this later. And then contract months. This basically is the months that are available for trading the futures product. So you can choose different contract months, like which months you want to trade. And then lastly, all futures contract have an expiration date that is fixed already. And futures have different expiry dates to choose from now, which is why you have different contract months. So for example, let's say now is is March, right? So if you trade a May futures contract, so the contract will expire in May. Yeah. The expiration date is the final day that the contract can be traded, and after the expiration, the contract must be settled. Okay, for cash settlement, as the name suggests, the contract is settled in cash. Okay, the parties will either pay cash or receive cash, depending if they are in profit or in losses when the contract expires. And cash settlement are more common with index futures like KLCI futures and Dow Jones futures, etc. And then for physical delivery, it involves delivering or receiving the actual goods. So the seller will have to deliver the goods, while the buyer will have to receive the goods when the contract ends up. So physical delivery is common with commodities such as CPO, corn, and soybean. How much amount to deliver was already specified in the futures contract. So, but usually for retail traders, right, they don't want to receive or deliver the physical goods. So what they do is before the contract expires, they will close their position by doing an opposite trade. So for a buyer, he or she will close the position by selling the contract before the expiration, and you can profit or pay the difference between the buying and selling price. Okay, this is an example of a contract specification for FCPO. So it stands for Crude Palm Oil Futures contract. The underlying instrument is crude palm oil, and then the contract size of one FCPO contract is equivalent to 25 metric tons of CPO. So you can actually calculate the contract value. Okay, for example, let's say CPO price is now trading at 6,500 per metric ton. Okay, so you multiply it with 25 metric tons, and you get a contract value of 162,500. Okay, next is the minimum price fluctuation is 1 ringgit per metric ton, and the value per tick is 25 ringgit. So what it means is that for every 1 ringgit move in FCPO price is actually equivalent to the value of 25 ringgit. Okay, for example, let's say if you sell FCPO at 6,005, right, and the price goes up 1 ringgit, you will lose $25. 25 ringgit, sorry. But if the price goes down 2 ringgit, then you will earn 50 ringgit. So that is how it works. Okay, next, the settlement is physical delivery. And for trading hours, there are 3 sessions. The morning session is from 10:30 to 12:30 p.m. And then the afternoon session is 2:30 to 6 p.m. And then lastly, the night session is from 9 p.m. to 11:30 p.m. Do take note that for night session, it's only from Monday to Thursday. Friday, we don't have night session. Okay, and then the final trading day of the contract is on the 15th of the delivery month, and the contract will expire at noon. And lastly, the initial margin or the capital required to trade one lot of FCPO contract is 9,000. Okay, next, this is the contract spec for FKLI. So the underlying instrument is the FTSE Bursa Malaysia Kuala Lumpur Index, Kuala Lumpur Composite Index, or in short, it is the KLCI. Okay, the contract size is the KLCI index point multiplied by 50 ringgit. So to calculate the contract value, you take the current price of the index. Let's say it's 1,006 in this case. And then you multiply it by 50, you get a contract value of 80,000. And the minimum price fluctuation is 0.5 point, and the value per tick is 25 ringgit. So every half point move will equal to 25 ringgit, and a 1 point move will be 50 ringgit. Okay, yeah. For example, if you buy FKLI at 1,006, and then when the index goes up half a point, you'll earn 25 ringgit. But if the index drop 1 point, then you will lose 50 ringgit. And then the settlement for FKLI is cash settlement. And for trading hours, also same, we have 3 sessions. The morning session is from 8:45 to 12:45 p.m. And then there's a break. After that, the afternoon session is 2:30 to 5:15 p.m. And then lastly, night session is from 9 to 11:30 p.m. So this one is also from Monday to Thursdays only. So tomorrow there is no night session. Okay, the final trading day for FKLI is the last business day of the contract month. And the initial margin required is 4,200 for one lot of the FKLI contract. Okay, so why do you want to trade futures, right? There are actually many reasons why futures is attractive, which includes like leverage, high liquidity, bi-directional trading, and also low transaction costs. So we'll look into each one of it. Okay, for leverage, futures is actually a leverage instrument or a product, which means that traders can actually trade on margin, right? Traders can use small amount of capital to trade a greater contract value. So normally the initial margin or the capital needed is around 5% to 20% of the full contract value. And what that means is that a small movement in the market can also translate into a big movement in your portfolio. Okay, for example, in this is FKLI. In the futures market, the initial margin is 4,200. So you can just use 4,200 to trade a contract value of 80,000 in KLCI, which is the cash market. So your capital required is just 5% of the 80,000. So this is basically what leverage is. Okay, let's look at an example of leverage with profit. Okay, and then we will compare the ROI if you trade in the futures market and versus if you trade in the cash market. So let's say you buy FKLI at 1,600. And then the market goes up 30 points. And then you will sell off your position at 1,630. So your profit is the difference, okay? 30 points times 50 ringgit equivalent to 1,500. So let's compare the ROI, right? If you buy in the cash market, you will need to fork out 80,000 for your investment. And your return on investment will be your profit, which is 1,500, divided by your investment amount, which is 80,000, and you get a 1.88% return. But if you buy in the futures market, you only need like 4,200 for the initial margin. So your profit 1,500 divided by 4,200, your ROI is 35.71, which is much higher than the cash market. And then we also look at another example on a losing position with leverage. So likewise, you buy at 1,006, okay, but the market is not in your favor and then it dropped like 20 points and you decide to cut loss and sell the position at 1,580. So your loss will be 20 points times 50 will be 1,000. And then now you compare the ROI, right? In the cash market, your ROI will be negative 1.25%. But in the futures market, your ROI will be negative 23.81%. So in both cases, right, the ROI are magnified in the futures market as compared to the cash market. So basically, leverage is also a double-edged sword. Okay, next, high liquidity. Most futures contracts are liquid, and liquidity is important when choosing which contract month to enter. So typically, you want to choose the contract month with the highest liquidity because there are a lot more volume. And a lot more volume means the contract is active because a lot of people are trading it. So the benefit of trading a high liquid contract is that you can quickly enter and exit your position easier and also at the price you want. And a liquid market will also mean a smaller bid-ask spread. Okay, this is an example of FCPO in our Phillip Nova platform. You can see under contract here, right? There are many different months like March, April, May, June. So how do you find the contract that is most liquid, right? You will look at the volume column here, and then you see which has the highest number. So in this case, it is the May contract. And same goes for FKLI as well. For the highest volume is actually the March contract. And also in futures, you can trade both ways. Okay, you can trade the upside and also the downside of the market. So if you expect the market to go up, you can long the market by buying into the position. And generally, you want to initiate a buy position when the market is in, when the market is in an uptrend. But if you expect the market to go down, then you can short the market by initiating a sell position. And you want to do this when the market is in the downtrend. And then next, the transaction fees in the futures market are relatively low as compared to the stock market or the cash market. So the commission for futures contracts or the brokerage fee, right, are based on a fixed fee, okay, per lot per site, rather than a percentage of the contract value. So in this example below here in the table, let's say we start with the same contract value of 80,000 for both futures and also for stocks. So just to make it even, so then we can compare the transaction cost only. So for futures, the only cost you need to pay is the commission fee, which is 15 ringgit for FKLI in this example. Okay, there are no stamp duty or clearing fees or on. So the total commission you pay to enter and to exit a position is just 30 ringgit. So 15 ringgit to enter and then 15 ringgit to exit. But whereas for stocks, the commission is based on a percentage of the contract value, and there are also other miscellaneous fees which may vary according to the contracts or the products. So in this comparison here, the fees in futures market is much smaller than the stock market. Yeah, futures market are also regulated by the government bodies or the industrial bodies, and this will provide fairness and transparency to traders. Yeah. All right. So basically, we just covered the first session on the basics of futures trading. So now let's look into the FKLI and also FCPO and what are the key fundamentals that drive these markets. Okay, we did talk earlier on the contract spec for FK already, so I will not go through again. Yeah. Okay. The components in KLCI. So the KLCI index comprises of many different sectors. As you can see in this pie chart here, right, the biggest weightage are the banks, the F&B, and also the healthcare sectors. So in total, the KLCI represents the top 30 companies by market cap. They are listed on Bursa Malaysia. So mostly they are the blue chip companies. And for FKLI, which is the KLCI futures, okay, it will track the index movement of KLCI. Sorry, yeah. So the advantage of trading the futures is that you don't have to worry about which stock to pick and trade. Like you don't have to go through or read through all the annual reports, right? The financial statements for all the individual companies. But because by trading just one contract of the FKLI futures, you are actually already exposed to these 30 blue chips companies. Okay, now let's look at the factors that may potentially affect the FKLI market. Okay, the first one is Malaysia economic data. Usually, the economic data will tell us whether our country's economy is doing good or bad. So that is why investors, they will look at these indicators when they are investing. So such data include GDP, inflation, employment data, and consumer spending, etc. So depending on how the company is doing, government, right, or the central banks, they will step in to devise the monetary policy. So to increase or decrease the interest rates, or to pump in or reduce some stimulus into the economy. So this will affect how businesses are doing, and also subsequently they will affect the stock market as well. Okay, next is the corporate earnings result. Generally, stock traders, they will tend to speculate on the financial performance of a company. So a company's earnings will tell how the company is doing, and also will give a forward guidance. So before the earnings report is released to the public, traders will try to speculate whether the company will perform good or perform bad, and they will kind of bet into it. So if they think that the earnings will do good, right, they might buy into the shares, and vice versa. Like if they think the earnings will be bad, then they will bet against it, or they will sell off some shares. So especially if the blue chip companies are delivering very strong corporate earnings, right, it will be beneficial for the FKLI index to go up. Okay, then the third one is global stock market performance. Okay, US is still the world's largest economy. Okay, so how the US stock market perform would somehow affect Malaysia as well. And another region to affect Malaysia market is the Asia market, because we are geographically closer, and we will do international trade together, like imports and exports. So that's why sometimes you see if China or Hong Kong or Japan or Singapore, right, their market is in the red, right? Their index is in the red. So KLCI may tend to not perform that well as well. And sometimes it might not necessarily have a direct fundamental cause, but it can also affect our stock market due to some spillover of the panic sentiment. Yeah. Whenever the last one is geopolitical issues, and whenever there is political uncertainties, the stock market will be very volatile. So I think this is very evident in the wars that we are seeing right now. Okay, these conflicts may potentially disrupt global supply chains and also international trades, and causing fears to the global market. So for example here, right, US and China trade war has a long history already, but it brings an indirect impact on the performance of our stock market. And because the trade policies between the world's two largest economies will affect how the rest of the world trades, especially when China is also a huge trading partner of Malaysia as well. And then we have the Ukraine-Russia war. One of the biggest fears it brought on the market is the possible shortage, right, of a commodity supply, such as crude oil, wheat, and sunflower oil. Because Russia is a major oil exporter, it supplies roughly 10% of the global oil. And Ukraine is also a large producer of wheat to the world. So if there is a war in these areas, it could disrupt disrupt the export and cause the commodity price to increase. And with increased prices in these commodities, and also on top of this high inflation that we already have, it will definitely affect business one way or the other. And then lastly, government decisions on policies and regulations have an impact on our economy as a whole. So there will be some market reactions to these uncertainties if there is an undesirable change in a country's political stance. Yeah. Okay, so this one we also go through already for the FCPO specs. So I think we'll skip this one. Okay, factors that will affect the FCPO market. Okay, let's look at it. Okay, the first one, weather season. So weather patterns tend to affect development and also the production of CPO because palm trees, they generally will grow well in the tropical weather, which is usually warm and humid. So if there are seasons of heavy rain or monsoon, okay, known as the La Nina, it could lead to increased rainfall and that may flood the plantations and hamper the harvest of the crude palm, the crude palm oil. Yeah. While during seasons of dry spell or extreme heat, known as the El Nino, there tend to be less rainfall, and that could create a stress effect on the palm oil development, which will also lead to the bring down the production yield. Yeah. Okay. Next, FCPO price is also affected by the import and export volume. So the top three producers or the exporters are Indonesia, Malaysia, and Thailand, while the top three consumers or importers of crude palm oil are India, the European Union, and also China. So you can look at the import and export as supply and demand. If the demand outweigh the supply, then the price of CPO will rise. Yeah. And then we also have competition from other edible oils. Okay, the price of palm oil can be affected by other vegetable oils such as sunflower oil, corn oil, and soybean oil. So if let's say, right, for example, if a bad weather hits the soybean plantation, it can lead to the increase in palm oil price, because once the soybean oil the supply cannot catch up with the demand, then buyers will switch to palm oil as a substitution. And then Ukraine and Russia will Ukraine and Russia, they are also the world's top two largest sunflower oil exporters. And due to the war, there are concerns of supply shortage for sunflower oil, driving the prices of palm oil at record high. Okay, and then lastly, festival season can also increase the demand for oil. Okay, for example, during New Year, okay, the Chinese will buy for massive cooking and also baking, and then the Indians will buy for Deepavali and so on. So people will use oil for festivals and also religious purposes. And again, like higher demand for oil, the price will increase. So yeah, these are some of the factors that could affect the prices of FCPO. Okay, now let's look at how you can use futures for hedging. Okay, hedging is a way of limiting risk that arise from large fluctuation in prices of the product that you are trading. So the purpose of hedging is that any loss you make in one market, okay, for example, the stock market, okay, can be minimized by a profit in the other market, which is the futures market. So for hedge fund managers and stock investors, they'll usually use futures to hedge their portfolio. Okay, so you also can protect your portfolio when the stock market goes down. Okay. For example, if you are holding some blue chip stocks in the KLCI index, you can expect, and then you expect, right, the market will fall. So you can sell the KLCI futures first to hedge against the falling stock market. Because the FKLI will actually track the movement of the KLCI. So if KLCI goes up, the futures will also go up. And then if a KLCI falls, and then the future will tend to fall as well. Okay, let's look at an example for more clear understanding. Okay, let's say, right, today is 20th of October. And then you hold some of the blue chip stocks here like Maybank, Top Glove, and Petronas. Okay, your total portfolio value is 20,500. Okay, and then today there are some bearish news that you think will cause the stock market to fall. So what you can do is you can short a futures contract on FKLI today. For example, you short FKLI at 1,006. And then over the 2 months period, okay, the stock market really dropped as you expected, okay, and then your portfolio value also dropped, okay, it became 18,000, for example. So you will take a loss of 2,500 on your portfolio. But on the future side, because you also shorted, right, and the price fell to 1560 lah, for example, so you can profit the difference, and will give you a profit of 2,000. So your total loss will be minimized to like 500 only instead of 2,500. Okay, this is example how you can hedge your portfolio, especially the stock market lah, with futures. Okay, then there's another type of hedger. They are the producers. Okay, for example, like the farmer I mentioned earlier at the start. Okay, producers, they will sell their crops to the consumers. So they can use futures to manage the risk and uncertainty of the crop price fluctuation by locking in the selling price. So what do I mean, and how do you do that? Okay, for example, let's say a corn farmer, right? He's worried that the market price of corn may fall when his harvests are ready for sale, let's say 3 months later. So instead of letting the price fluctuate, he can actually fix the selling price. So in this case, he will want to lock in a selling price of $5 per bushel, for example. So what he can do is he can sell a futures contract today at $5. Okay, so these are just example of the futures contract details. Okay, and then on the contract expiration date, let's say on the June 14th. Okay, the first scenario, let's say the market price of corn rose to $6 per bushel. So the farmer will incur loss of $1 on the futures contract because he sold at $5, correct? But he can sell his corn at the market price of $6. So his net sell price is $6 minus this $1 loss equals to $5. And then on another scenario, okay, let's say the market price of corn fall to $4, and he will profit $1 from the futures contract, but he can only sell his corn at market price of 4. So his net sell price is $4 plus $1 profit equals to $5. So through hedging using futures, right, it doesn't matter how the market price fluctuates for corn. The farmer, he can still sell at the price that he wants. So just now was a producer hedge. Now we also have a consumer hedge. So it refers to vendors or manufacturers who need to buy the crop to produce the end products. Okay, they will use futures to hedge or lock in the buying price. Basically, the mechanism is the same, but instead of selling futures, you buy futures instead. Okay, for example, we use the popcorn vendor lah. Okay, she needs to buy corn to make popcorn. So she worries that the corn price may increase in the near future and then leading to a higher cost. So she can fix the buying price at say $5, and she'll buy into the futures contract at $5 as well. So On the contract expiration date, let's say if the con price increased to $6, she will make a $1 profit on the futures contract because she bought at 5 and then increased to $6, so she made a profit. But she has to buy the con at market price of $6 and then giving her a net purchase cost of $5. Okay, and then if the con price drops to $4, and she will incur loss of $1 on the futures contract. But she can buy corn at a cheaper market price of 4. So the net purchase cost is still $5. Okay, so you get you get the example, right? So this is how commodity hedges can lock in the buying and selling price. Okay, usually for physical delivery products lah. But for majority of retail traders, like I guess most of you, you don't want to hedge commodities, but you like to speculate on the price movements. So now we'll talk about how you can use futures for speculation. So speculators are traders who forecast a short-term price movement in an asset, and you buy or sell the contract with the hope of making a profit when the price goes in their favor. But if price moves against them, right, they will also lose money. So speculation is the most common market activity that participants of a financial market take part in. And speculators also bring liquidity and assume market risk, which makes them important players in the market. Okay, we look at an example. If you expect the price to rise, okay, to increase, you can long the futures contract and then sell it after the price goes up to profit the difference. So for long positions, you want to buy at a lower price and then sell at a higher price. Here is an example of FCPO 5 minutes chart. This is taken many months back when FCPO is still relatively cheaper. So if you use technical analysis, you'll buy at support, right, and sell at resistance. So because you'll see, right, support here, the prices tend to bounce off from the support, and for the resistance here, prices tend to reject them. So for example, in an uptrend channel here, okay, you buy when the price touches the trend line support. So for example, you buy at 3925, okay, and then the price goes up and reach the resistance. So you can sell at 4015. Then your profit will be the difference between your buying and your selling price. You times 25 because the value per tick is 25 for FCPO. You'll get a profit of 2,250. So this is an example for if you're speculating a long position. Okay, now here is a short example. If you expect the price to fall, you can short the futures contract and buy it back after the price drop. And then you can also profit the difference. So you want to sell at a higher price and then buy it back again at a lower price. So let's look at an example. This is FCPO daily chart. Okay, so this is a downtrend, right? Price tends to reject the resistance. So let's say you sell FCPO here at 2440, okay? And then if the price drops and touch the support, you can buy it back at 2280, for example. Okay, so your profit will be the difference times 25 equals 4,000. So this is an example of speculating a downtrend movement. Yeah. Then moving on to margin call. Okay, I think this is important for all traders to know, because if you get a margin call, it means your equity is running low. So we don't want that, right? So okay, for example, let's say you are holding a contract, and if your equity falls below the initial margin when the market closed today, then you will receive a margin call tomorrow. Okay, if you have a margin call, you will need to either top up money to cover the deficit, or you have to close your positions. So how do you calculate a margin call amount? You take the initial margin minus your equity balance. We also have an example here. So for example, you want to long FKLI, so you buy, but let's say you start with a equity of 5,000, and then you buy FKLI at 1,600 today, all right? And then the market closed at 1,580. So the 20 points difference, you times 50, give you a 1,000 ringgit floating loss, okay? So your equity balance will drop to 4,000. And then the next day, you'll get a margin call of 200, which is your initial margin minus your equity balance. Okay, likewise, if you want to short FKLI, okay, let's say you enter short today at 1,600, and then the market closed at 1,630. So 30 points difference times 50, you have a 1,500 floating loss, and then your equity balance is left 3,500. So the next day, your margin call will be 700. So this is how you can calculate the margin call amount. So yeah, now that we have learned about some basics of futures trading, we also look at the examples of different contracts. So how can you begin trading? Okay, first, of course, you will need to have a trading account. So you can choose to open an account with us, Phillip Futures. It's free. And then you also, secondly, you need to know your risk appetite. Okay, because some markets can be more volatile than others because they can be more sensitive to certain market news, for example. But it is also because of volatility that will give traders the opportunity to trade the movement in the market. So just for risk management, right? Always remember to set a stop loss and also monitor your position. Then I'll study the products that you are interested to trade in. And it is also important to understand the fundamental analysis and also technical analysis. For fundamental analysis, you can read the news, okay, follow the important key data or reports that will affect the markets. And for technical analysis, it's basically like knowing or understanding how to read the charts, and also, you know, some people, if they use indicators, you can use indicators such as moving average or RSI and so on. So different traders may adopt different techniques, but most importantly is it has to suit your own trading style. Then you will start your trading journey and make sure you are always up to date with the market, right? Because any news or events could really move the market. And trading is a long journey, so always keep learning and growing your knowledge. Okay, so lastly, I wish you the best of luck in your trading journey. Yeah. Okay, so basically that's pretty much all for my session. I hope you do learn something tonight, right? If you have any questions, you can type into the question box and I'll try to answer them later. But meanwhile, right, just for your information, if anyone who is looking to open a futures account with Phillip Futures, you can scan the QR code here, and it will take you directly to the online application. Because Phillip Futures is the first broker in Malaysia to introduce this account opening online. So it is very easy to open. It's simple. It just takes you roughly 10 minutes. You need to fill in your particulars and upload some documents for verification, and then fund in a minimum of 1,000 to activate your account. But you can also use this 1,000 to trade later, so it's in your account. Okay, the trading platform that we use is Phillip Nova. It is a web-based platform and it's simple to use. Basically, you just log in like how you log in your Facebook lah, and then you can trade already. So inside the platform, we have over 90 indicators. We also have live charts. They are free, okay, and you can also access to both local and foreign products. And we also have a demo account for you to try out platform. So if you are interested to try out, you can scan here to register for a demo account, or you can also approach us to register for a demo account lah. Okay, we also have a mobile app version for our Nova platform. So for those who are not always in front of the computer, or you like to trade on the go, you can download our Phillip Nova app and trade anywhere you like. You will still get the same features like the live charts inside as well. Okay, currently we are running a few promotions. Okay, the first one is Phillip Star products. So you can trade micro crude oil, micro gold, and also the China A50 as low as USD 3. This is per lot per side, yeah. So these are mostly for micro products. For micro products, it means that the margin are usually smaller lah. Yeah. So this promo is for foreign products traded in USD. So I have a poll here. Maybe you can let me know. Let me see. Yeah, you can help me to just select. You can select multiple answers like which products you'll be interested to trade. So the first one, we have the micro crude oil, which is MCL, and then we have also micro gold, and also the FTSE China A50 index. Yeah, okay, I see a lot of people is actually very interested in the crude oil, right? Because of the recent very high, because of the war, right? And then the prices of the crude oil really spike up very high. Okay, all right. Thank you for the response. Okay, and then for the second one, this is called the Ongsome Rewards. Okay, you can get cash rewards and also Foodpanda vouchers when you open an account and also start trading with us. So of course, the more you trade, the more cash reward you will win lah. So this promo is for local Bursa products. So I also have a poll here. Maybe you can let me know, right? Which local futures products are you keen to get started? So you can choose multiple as well. Here we have the FKLI, which I gone through just now, and then we also have an FM70. This one is basically the 70 mid cap stocks lah. And then we have FCPO and also FEPO. FEPO is basically also crude palm oil, but it's Malaysia crude palm oil. I see. Okay, a lot of people are interested in trading FCPO. Okay, that's great. That's great. All right. Thanks for your response. Okay. So you can also connect with us on these platforms. You can find us on Facebook, LinkedIn, and also YouTube by searching Phillip Futures Sdn Bhd. And we are also on Telegram. You can search Phillip Futures and join our Telegram. And we post a lot of our market updates there. And we also regularly post updated news, events, and also promotions on our social media. So be sure to follow us so you will not miss out with any updates that we have. Okay, our recorded videos and also our webinars are also uploaded on our YouTube channel. So you can actually go over to watch our previous videos there as well. Okay, lastly, this is our Kuching branch contact for you to reach out. You can take a screenshot if you want. If you have any inquiries, you are always welcome to contact us. Okay, so yeah, back to Q&A. Let's see if you have any questions. Yeah. Okay, give me a while. Okay, how to get the weightage of KLCI component? Actually, this one you can just Google. All right, it's available in Google. You just Google the KLCI component because they may change from time to time. So yeah, you can go and find it there. Right, just Google you'll get it. Okay, next. Let me see what's this. Okay, if I short KLCI, how to use KLCI to hedge when the contract expire with loss? Basically, if you're talking about your futures, is it? Like if you trade the futures FKLI, usually, sorry, I don't quite get your sorry, I don't quite get your question lah. Can you like elaborate what you're trying to say? But okay, for example, if you are shorting FKLI and then it's close to the contract expiry, you can actually close and then you roll over. Means you close your current current contract and then you buy in another contract at a further month. So that's how you can roll it lah. Okay, there's another question. What is the time frame to trade for day trade? Actually, this question is quite subjective because it depends on different traders. Some people like to go with a shorter time frame, like 15 minutes or 5 minutes, but those are usually for scalpers, right? They'll scalp. So if the lower time frame, if you go down to a lower time frame, basically I would think that the noise are higher lah. So if you want a more accurate view, maybe you can go with 1 hour or 4 hour. But it also depends on what kind of products that you want to trade. Yeah. Okay, is there any other questions? Okay, for questions about like commissions, we will have our representative to contact you on this, and then you can let us know what kind of products you want to trade, and then we'll let you know. So yeah, we will get back to you on that. Yes, right. Our webinar is recorded for replay. We will put it up on YouTube. So if you attended our webinar, we also send you the link that you can rewatch lah. I think that's pretty much all for the questions. If there is no other questions, then I think we will end the webinar tonight. So if you still have other inquiries you'd like to ask us, you can always feel free to contact us, and we'll definitely be happy to help. So yeah, I really hope you do learn something from this webinar, especially for the beginners. And so thank you once again for joining us, and we will see you in the next webinar. All right, take care and good night.